In this month's Backstage Pass, I've been asked to give a couple of differences that I see between the 96% who struggle with money and the 4% actually create financial freedom over time, and what are some of the mistakes that I see the 96% making. So I want to talk about two key differences and three key mistakes that I've now observed through thousands of people. And the first key difference is that the 4% know that the game is to buy their time back, and so they are paying themselves first. More specifically, they are paying their future self first. So when they are saving, what they're actually doing is putting money out to work to earn money, so that the more their money is out working, the less hard they have to work. So they prioritize this. And invariably, the first person that they pay is actually their future self. So the first bill they pay is actually a direct debit, a direct transfer into their future fund, if you like. I call it the freedom generator. So the money goes out to work to progressively buy their time back. And this is a key difference that the 96% generally are not doing. The 96% generally, they are not saving. And when they are saving, they're not saving to buy their time back. Their saving is usually a disguised way of setting money aside for a planned future expense, like it might be for a holiday, or a deposit for a house, or kids' college education. And whilst all of those things can be important for enjoying life today, none of those things actually allow you to get on the journey of buying your time back. So we see the 96% spin and not get ahead, whereas we see the 4% actually progressively get ahead because they are paying their future self first. So that leads me to the second key difference that I see between the 4% and the 96%, and that is the amount of debt that they carry. Generally, the 4% don't carry any more than about 25% of their take-home pay going to debt payment costs. So usually they might have a modest home mortgage, but they're not borrowing money for cars, they're not getting into credit card debt, they're not getting into store borrowing money for household furnitures and things like that. Whereas what we see the 96% doing is usually we'll see as much as 40 to 55% of their income going to bank interest payments. And that's a massive difference. When you see 25% only going out for the 4% and 40 to 55% going out to the 96%, you can see how much easier it is for the 4% to be putting ever increasing amounts towards buying their time back, whereas the 96% end up just struggling. So what are the mistakes that they're making to get themselves caught into debt in the first place? And so, I mean, the obvious side is to live within your means, to only buy things that you need. And that's spoken about a lot, but specifically there are two key mistakes I see the 96% making time after time. And the first is they're not making allowance for irregular expenses. So what that means is they're spending paycheck to paycheck and they seem to be okay month to month, until that big bill arrives, the big bill that comes in once every 6 months or once a year or once every 3 months, and it's too big a bill that for them to actually pay out of that weekly or bi-weekly or monthly paycheck. So they just go into debt. They just put on the card hoping that they'll pay it off, and invariably they don't. Now, one of the simplest ways to not fall into this trap is to not spend discretionary money out of the same bank account that your paycheck goes into, but instead to actually have a separate everyday account where your discretionary expenses come from. Things that you can vary, things like grocery bills or petrol costs or going out for entertainment or dinner or things that can vary. Pay yourself weekly into that everyday account a certain amount. People that do that generally find it's very, very easy to stick to that amount. They don't overspend, and their actual income account, the main account that their income comes into, that they use to pay the regular bills that don't vary very much, that naturally builds up in balance and can pay those irregular expenses quite easily when they actually come about, just through creating that separation. And the second key mistake that we see the 96% make is they're not putting money aside for those planned future expenses, for things like their car replacement or they know they want to do renovation to the house, or the holiday they want to take, or the kids' college education. They're not putting money aside. So when those things invariably come up, like the car replacement or like the holiday, the normal thing, unfortunately it's normal, but it's financially catastrophic. The normal thing is to put it on the card or borrow some money or take equity out of the home loan, or take extra debt out of the equity in the home in your home to actually pay for those bills. And unfortunately what happens then is the 96% again carrying that little bit more debt, means that that little bit more vulnerable. So when the next surprise comes about, it's just that little bit easier to go into debt. And over time, what you see happening is they're spending more and more time chasing their tail, trying to get out of debt. Whereas the 4%, by setting money aside for those planned future expenses, setting money aside for the car replacement, so when the car does need to be replaced, they pay cash. Or when the holiday comes out, they're paying it cash. Or the kids' college education, they're paying it cash, or the renovation to the home, they've actually saved the money up to do that. That difference over time means that the 4% accelerate towards freedom because they've got ever-increasing amounts being available to set out to go to work. So the money's going to work for a paycheck, whereas the 96% are spending ever-increasing amounts of time trying to get out of debt. And that time they're spending getting out of debt and without changing the reasons why they're going into debt in the first place means that they're focusing on the wrong thing. They're focusing out of getting out of debt rather than focusing on how they actually create their freedom. So two key differences that we're seeing there is the 4% know the game is to buy their time back. So they are paying their future self first. So their long-term savings rates, money that's being set aside for their future self, is much, much higher than the 96%. And the second thing that's happening is the 4% are not getting into debt. They're carrying no more than 25% of their take-home pay going out into debt costs, and invariably even their home mortgage is gone by the time they're 50 at the latest. And so they've got ever-increasing amounts to be setting aside for their future self. Now, the 96% are making the mistakes. They're not paying their future self first. If they're putting money aside, they're paying it late. They're getting caught up with irregular expenses, and they're getting caught up with not making allowance for planned future expenses. All of those can actually quite simply be changed by working out how much you can pay your future self first and honoring that process to go first of all, and then setting up the right account structures so that you're creating some separation so that your money goes into an income account, but you actually live with your discretionary expenses out of an everyday account, and you put separate money aside for planned future expenses. If you look at making those couple of changes, it's really not very difficult at all to relatively quickly start pivoting in towards the same sort of habits that the 4% are actually making. And the cool part about it is while the starts might seem a little slow, by practicing these habits, you start spiraling up, like go north like a homesick angel, of getting more and more of your money progressively going to work for you. And freedom is just then a matter of time following the right principles. So the game is buy your time back. And what I encourage you to do, hopefully you've got some benefit out of what I've just shared with you here, is look at the habits of the 4%. Don't look at the 96%. And choose where you want to be. And what I encourage you to do is choose freedom. So if you're seeing this video anywhere other than on the MindShift.money site, I encourage you to track away to MindShift.money, sign up for a free subscription there, and get within the community that is helping you get yourself on the path to freedom.